You're listening to the Valley Current.
Hey, Steve, welcome into the Valley Current.
There we go.
So I thought we should cover, as a special edition of the Valley Current, if you're open to it, what might be called a big topic about spring cleaning people often don't do, but now they can do because the COVID-19 epidemic, which maybe is starting to get better, maybe it's worse, who knows, let's leave that to one side. But assuming it gets better, there's a July 15th tax filing date based on the adjustments that were made from April. So you actually get to do some spring cleaning with the July date in mind to do some smart things. I assume you could still do smart things, but maybe you'll tell me, no, you can't. The July date is just a shift of the filing date. It's not a shift of when you could deposit into IRAs or when you could do other things. So I thought maybe we should spend at least 10, 15, 20 minutes talking about the typical spring cleaning that you would think annually or maybe even quarterly, individuals, couples, small businesses. It's a bigger topic as you add, more categories of people. Maybe we just start small for now and talk about individuals, and then maybe next week, if we run out of time, we could talk about couples. I look at individuals and couples like a unit. So if they're filing the same tax return, probably you treat them the same, right? Together, more or less?
Yes, absolutely. And unless you're in a collection situation with the IRS, or unless you distrust your spouse so much that you won't even touch a piece of paper that your spouse has touched, then probably the two can be considered a single entity.
Right. I mean, people should know spouses sometimes do wacky and crazy things. They steal money, they go to jail, they murder people. I mean, a million different things happen to spouses, and sometimes the quote innocent spouse gets dragged into the story. I could tell a lot of stories about that. I've seen a lot of cases, but in general, let's take the model where the spouses are cooperating, they trust each other, they're filing a single tax return, and the net result is they have a household unit, which I try to say to the couples that I sometimes represent, I'm sure you do too, you should think of the household like a little LLC. It's like a little company, just like an estate is a little LLC that has to deal with wrapping it up its affairs and winding up. It's like a separate entity, just like a business can be in an LLC or can be a sole proprietorship. LLC meaning limited liability company, very simple structure, one of the simplest ones that's ever been created, originally in Wyoming, but we won't digress. Conceptually, do you think of it as every year the couple or the LLC or the household or even the individual should be looking at these various 7 or 10? I think there's actually 10 factors. Some people think there's 7. Some people would say a dozen. I mean, maybe we'll reduce it down to 7 or 10. We can certainly, reel out more over time. Do you think it's an annual thing, or do you think it's like quarterly, or how do you think of it? Because I don't think it's every 10 years. I think it's got to be shorter than that, right?
It should be at least annual, I think. I had the unpleasant experience recently of losing a client due to an accident where the client was incapacitated and ended up in a vegetative state before the plug was pulled. And it just emphasized the importance of updating the trust and estate. That's something, and the durable medical power of attorney. And that's just critical, because without that, the entire estate can be consumed in a huge mess if you don't have a durable medical power of attorney.
Oh, I mean, there's basic documents that can be obtained online. California Bar has published a durable power of attorney, a very standard form the courts treat appropriately. They've published a standard will. I think they may even have a standard revocable living trust or living will, even online for free without charge. The only thing they don't do is actually type it for you. I mean, it's pre-typed, but they don't have a way for you to just plug in your name and have it automatically generate. They force you to print it and kind of write it out by hand. I think that's stupid. They should actually allow people to edit it online to create a nice printed version for signature. But that's just my beef with the bar, that they drew a line that sort of makes it so it's a little more difficult. In the ideal circumstance, they have an app, and the app would just suck in the data about you from your Facebook account and maybe from your LinkedIn account, and it would tell the story of whatever those documents need to do. But the bar is respectful that there's still a big trust and estates group of lawyers that are fighting against the trend towards automation, as are lots of other lawyers.
Well, there's a lot of things that can be missed without adequate review. And for example, many extremely wealthy people lose the benefit of having a trust because they don't remember to update the trust each year and to catch all new real estate, all refinanced real estate, all new IP, and any new accounts that have significant value.
Right. People don't realize that the entity does not automatically capture by default all the assets. So as you add a new piece of real estate, you actually have to assign that real estate into the trust. And a lot of times the real estate brokers are not even savvy to that. They just get the deal done and they think, oh yeah, we'll title it in your name because you're the purchaser. The truth is your trust should be the purchaser, and the trust should actually either be down as the owner / of title, or it should show that you've named it of title without there being, sort of additional paperwork. But when you go over the top 10, I'm going to give you mine, and maybe we can go in rotation, but I've seen various lists. I would put these lists in different order. I would start with, if you're doing an annual review, I would start with try to organize your online security to protect your virtual identity. So much money can be lost. You and I both know, without mentioning the couple's name, they were an older couple. They still are alive as an older couple. They lost over $2 million to a hack that occurred on their account at a big bank. And they fundamentally, I don't know what portion of their net worth, it was a pretty significant portion, but they got taken advantage of by virtual attack that was a combination of technical means and what might be called behavioral deception that deceived both of them, or at least one of them, certainly at least one of them, into agreeing to do things that would really so be considered extraordinary. And maybe it wouldn't happen to either of us, but when you're an older person, you're in your 70s, headed to your 80s, it's just not that easy. It's just not that easy to imagine that there couldn't be such a thing. In fact, I'd say the odds are no longer just possible, but even probable that such an attack will occur. So you have to put your security in order. And of course, you can extend that from virtual security to physical security, because part of the break-in of a house often is finding passwords on Post-it notes, finding computers that are unpassword protected. I mean, so much sort of Murphy's Law. Murphy was an optimist. Everything that can go wrong will go wrong. I think of that as the very first thing. I don't know what you think.
Yeah, absolutely. That situation was particularly tragic because of the new tax law, which kind of espouses the kick 'em while they're down philosophy of our current political leadership. And you can lose this huge amount of money and you get taxed on the loss. So not only are you out, you have no money, but now you have no money to pay a huge tax bill, which would otherwise be due.
Right. Now, I wonder whether you could address the tax situation by arguing that it was such an amazing, surprising event that it's like a tragic thing that happens when there's a storm or a hurricane and you lose a bunch of stuff. I mean, isn't there some notion that when it's sudden? I remember from my years and years ago tax studies, because in one rendition, I thought I was going to become a tax lawyer. That's kind of a whole separate conversation for another day. And I remember there was something in the code that dealt with when it's really sudden and unexpected and unpredictable and sort of unforeseen, the tax code gets a little easier on allowing deductibility or what's sometimes called a tragic loss. But you tell me what the right wording is here.
Unfortunately, the Trump tax changes have removed that from the tax code
Entirely.
Yes, the loss deduction is gone.
So is there nothing you can do? Is there nothing you can assert as a position that this was one of those things that somehow should be adjusted? Because your point is you lose the money, and if any portion of it represented income that was taxable, you still have to pay the taxes. Period, full stop, right?
We took a very interesting approach, and fingers crossed that the results will be favorable. But anything in this area is really exploring a new territory. As a worst case, one can do something once the tax bill reaches collection. We could do something like a claim for efficient tax administration that, hey, this person doesn't have the money and there's social reasons not to enforce it. But the commissioner does not have to accept such a request. And by that time, the person already has no assets left. So it's a very bleak situation, and you're better off not going there.
So it's really one of those things where it doesn't matter what happened. If you have that loss, you're not going to get any help from Uncle Sam, period, full stop. And you may or may not have insurance to cover it.
You might find a good lawyer and a good, brave lawyer and try and find somebody to sue. But it's a very bleak situation. And so your best approach is certainly do this annual housekeeping. Make sure that not only are you secure, but you've got a nice backup of all key information.
Right, and a backup should be a serious backup, as you know, because if you don't do that, you may be out $3,000 or $4,000 having a hard disk repaired, as you recently experienced yourself, right?
And you want to have a copy of the backup stored off-site at a different location so that a fire doesn't take out the backup.
Right. So we'll talk about backup another time, but let me just tell you that the other aspect of this kind of security is you start looking at maybe you're perfect in terms of your security, but your spouse is lax. I know some spouses who park a car and leave the key in the ignition. I swear their view is it doesn't get lost that way. I'm not going to condemn my spouse, and I'm not going to condemn anyone else's spouse, but I've seen the mindset of, oh, I park it in, Palo Alto. No one ever does anything illegal in Palo Alto. Let me tell you something. People do illegal things all over the world, and you leave your key in a car, and that car gets used in a robbery or that car gets used in a hit and run, you're going to be potentially liable for enabling that criminal act. It won't make you a criminal, but it will make you a potential contributory fault defendant in a lawsuit over the loss. So the first thing we're talking about, and we'll go over at least 7 or maybe 10 of these, is your online security and maybe your security generally. And then I would kind of reorganize around maybe number 2 is kind of looking at, well, what can you do generally to build towards the right tax treatment of whatever it is that you're doing? Like, for example, if it's the right time to refinance your property, whether it's your house or your car even, the rates have dropped. Is it a good time to look at your financial condition? And this is why I think maybe it's more than annually, because maybe you look at your financial condition quarterly. Of course, most people don't. But, rates change, credit cards change, financing changes. And if you're fully employed and you've got a great FICO score, 750 or above or 760 or above, I forget where the cutoff points are, maybe even 680 or above, you can get a really good loan. And I think that 15-year loans, I've heard they're as low as 2.5%, which is unheard of these days on what might be, a standard 700. What is the limit? 770, the typical
750, yes.
Yeah, it's like 750 is the typical rate for what might be called the starter home in California. I mean, anywhere else it would be a mansion, but in California, a starter home. So if you have a loan that you're paying 5-6% on, and you can get that refinanced to anything below 3, you're saving 50% on the interest. That could substantially lower your monthly rate on $750,000, right?
Absolutely.
But I mean, how often should people look at that? Because that's something where you'd say, well, you know, we don't even think about that every 5 years, but maybe you should think about that monthly as you make the monthly payment. Literally do that spring cleaning and say, well, wait a minute, there's a much better rate that can be achieved. Because I think a lot of people set auto pay and then just forget about it, right?
A lot of people do their taxes themselves or decide it's too much trouble and come to me at the last minute. And with only a day to prepare a complex tax return, we're going to file an extension and do it by October. Some people wait until October.
Is that because people are just lazy, or is that just because they think they can do it and then they realize it's too much work to do? I'm kind of curious.
It's human nature to procrastinate. There's about 10 good reasons to at least consider using a tax professional rather than attempting it oneself. One of the biggest is having somebody else to share the responsibility so that if something does go wrong, the taxpayer is not entirely to blame.
Well, people don't realize that's a huge value that you bring to the table, because having you at someone's side instantly gives credibility to the return, and it instantly allows people to also have a more defensive position, right?
Absolutely.
Say, hey, my tax professional CPA did this return. Don't ask him why he took this deduction. I just showed him my QuickBooks account. He went through it and pulled all this stuff, right?
It was a miscommunication between the client and the tax professional. So absolutely, it really gives an extra layer of insurance to protect the taxpayer in such a situation. But it also gives credibility so that if the tax return is used to obtain a loan to refinance or even a PPP loan, then you've got a professional signature on the bottom, which gives it more credibility to the lender.
Right. So people don't realize this stuff all plays together, because you as an outside advisor will likely tell that story of, hey, step one, let's make sure your security is good. I'm not a security professional, but I know enough about what can go wrong that I can lead you to do some of the right things. And then maybe you get a second audit from someone else. Number two, let's look at what your real estate and other assets are financed at, because I can connect you with various people and I could help you think through the refinancing. Plus, I think you're also a real estate broker, so you could actually even potentially help put together a private party loan if somebody doesn't quite have the credit score, right?
I'm not a lending broker, but I do know some who are actually able to close a deal even for self-employed borrowers, which is a huge challenge. And many of the people looking for financing don't really appreciate that the exact rate is less important in many lending situations than the ability to actually cough up the cash and close the loan.
Right.
And if you try and go for rate entirely, you may end up spending months with an underwriter while the deal falls through.
Right. So then number three, after you get done with the refinancing ideas, then you go to what I would call maybe the most challenging part, and maybe you get involved in it, maybe you don't, which is presenting some type of forward-looking budget for how you're spending your money. And I think of it as start with the big numbers and then go down from there. So rank the numbers on the big monthly expenses, the housing expense, the tax expense, the insurance, the maintenance, the household food and electricity, utilities. Like you could rank these. If we're taking a simple budget of $10,000 a month, and that might seem high, it might seem low to others, and 4,000 of it is for the housing, and another 1,000 of it is for a car and all of its, support, insurance and gas and all the rest, and another 1,000 is for taxes, but maybe it'd be more than 1,000 for taxes, so maybe it's 2,000 for taxes, and another 1,000 is for household groceries and the like, you're quickly going to realize that there's not a lot left to spend a lot of money on mochachinos and lattes at Starbucks, right?
There's a discipline issue here, and I'd say that 10% of my clients, maybe less, 5% have this issue. I frequently give them a spreadsheet and an exercise. First of all, to make sure that the actual expenditures match the conceptual expenditures. Oftentimes people don't even know, they're not conscious of what comes in and goes out. And the actual mochaccino budget is much higher than was expected, or vice versa. Also, once you've got accuracy and information and a good understanding of where the money is going, you also want to think about the value of your time. So sometimes there's an arbitrage between time and money, and things that are being done should be delegated, or things that are being delegated should be done.
Right. So if you think about that from sort of like an interesting, how do you do this as a couple? It probably gets far harder to do this as a couple, where there are some difficult conversations about how much are we spending on dog food? How much are we spending on cat food? Why did you buy that dress, or why did you buy those sneakers? You know, there's always these issues where the sole person who runs his or her own life. There's a great Fidelity commercial that runs on PBS NewsHour every night. It's this woman who looks very strident. She's obviously going towards middle age. She has just gotten a divorce, man, and she is moving on. And it's like, you know, life throws you a curveball. You head in different directions. The message is pretty much, you're on your own. Now your partner should be Fidelity, because, you know, you dumped that lousy SOB, you know, you dumped whoever your partner was or your spouse was. Watch that at some point with the mindset of, is that person a single woman that just got out of a divorce? Because every time I hear that commercial, I say to my beautiful wife, Dr. Lee Suter, they are so targeting particular people in that Fidelity commercial. And I hate that commercial. I can't tell you how much I hate that commercial, because the message is pretty much, hey, if you've been thinking about getting a divorce, don't worry, you should get a divorce. But the point I'm making is, I'm not really sure Fidelity does budgets with people. I think they just want to manage money. But the truth is, to manage money and to manage money well, you really do need to understand the budget, because you need to understand how much can be put away as savings. What can be put away for a rainy day? What can be put away into an IRA? What can be put away into some other pension plan, right?
The other arbitrage that you touched on just there is the interest rate arbitrage, in terms of paying down high interest rate debt first, and then shifting money from low interest rate investments into high interest rate investments, and then cashing in annually on tax benefits, low-hanging fruit, and loss that is locked into assets that can be appreciated in key years. Especially, there's a special little win for disposing of partnership investments, and you can control the timing and the tax when you recognize that tax benefit.
Right.
So it is an annual exercise, because taxes are done annually.
Right, but a lot of people just can't get into the mindset of actually doing it, because it feels a little bit like flossing your teeth, which we all know we should do. But I have to tell you, it's probably, if you talk to most dentists, most people don't do to their detriment, and most people don't do it appropriately, and most people don't do it sufficiently well, or with, you know, sufficient rigor or systematic, you know, sort of systematic approach. So then number 4, the way I think of it, number 4 is, once you've got your budget done, then you really can start to think about, what can we put into the pension plan? In other words, what can we actually do with excess cash? If there's no excess cash, there's no way you should be putting anything into a pension plan, right? Fundamentally?
It's slightly complicated. So especially with the new opportunities brought by the PPP loan situation, which can be spent on a retirement provision for the owner of the business. And in particular, a Roth IRA is designed for years in which there is no income. Many people use a Roth incorrectly, A Roth really is only applicable to a very small percentage of people, but those people who did have a low-income year can reap huge benefits by doing a Roth conversion.
Okay, no, so we'll cover each of these in more detail. Let's at least get through the first 7. So we're at the point of dealing with the pension fund. Then you get to like maybe number 6, if you really are forward thinking. What does your will? Do you have a will? Do you have a trust? Do you have durable a power of attorney? And does that need to be updated? Does all that paperwork need to be updated? Are there things you want to mark specially for particular people? I mean, in a time of COVID-19, I think a lot of people just don't appreciate that doing some estate planning and family planning makes sense. And maybe if you're going into surgery, I had a friend call today, he said, I'm going into surgery, I'm a little worried. Do you think I should do a will? Do you think I should do a trust? I said, absolutely. He said, do you think I'm being too negative? I said, no. And I said to him, frankly, I'm not sure you should go into surgery. Go into a hospital at a time of COVID-19, maybe like going into the DMZ. It's a danger zone. You don't want to do that, right?
Insurance is also a good thing to revisit. And in these COVID crazy times, especially workers' compensation insurance, because anybody, even a nanny who's considered a subcontractor, may be considered an employee under workers' compensation.
Right. So let's hit number 7 because that ties to insurance as well. And I thought of insurance as number 8, but let's call them 7 and 8. Build your home inventory of what do you have that's an important possession, and where do you want it to be disposed? Do you want it gifted? Do you want to give it specifically? Do you want it to be given to charity? I mean, those forward plans are done. 8 would be to cover things like insurance. 9 would be to cover the nanny situation with appropriate contracts and appropriate withholding and appropriate arbitration clauses. And then 10 is to actually look at what is your agenda for improvement on all of these topics, because all of these things are subject to continuous improvement. And with the right advisors, and Steve is one of them. So Steve, tell people how they can reach you, because that's the important part of the podcast here.
Steve Rabin, CPA, that's spelled R-A-B as in Bravo, I-N. And you can reach me at srabin@srabin.com or cell phone 408-887-6433.
And Steve brings a wealth of experience and an MBA as well as a CPA, as well as a lot of tax experience and a lot of defense against the IRS type experience. So he can cover the waterfront, and he does it very well and very efficiently and relatively inexpensively compared to like if you went to a big firm for sure. You'd spend a fortune. And I'm Jack Russo. You can reach me at jrusso, J-R-U-S-S-O at computerlaw.com, 650-327-9800. Thanks, Steve, for coming in this afternoon. We'll look forward to next week. Maybe we drill down on some of these subjects in a lot more detail, because there's certainly a lot more to talk about.
Sounds good. Be safe.
You take care. Bye-bye.
Bye.
Tune in next time on the Valley Current.